Welcome to this virtual reunion session. Today, we are pleased to be joined by Gita Rao and a panel of MIT Sloan alumni. Gita is a senior lecturer of finance and associate faculty director of the Master of Finance program at MIT Sloan. She joined the MIT Sloan finance faculty over 2 decades of experience in global investing, asset allocation, risk management, and client services. She managed the first global ESG portfolio in the United States, developed and teaches courses on social impact investing at Sloan, and is faculty director for the MIT Sloan Impact Investing Initiative. She is a trailblazer and a wonderful mentor to our MFin students, and we are so delighted to have her here today to lead us. Gita, take it away.
Thank you, Patsy, and welcome everyone. We are back here on Zoom again, and hopefully not for too much longer, but it's wonderful to be with you all, and thank you for your support of the school. We're looking forward to a very interactive session today. As they say, 10 minutes on Zoom is like 30 minutes in real life. But I'm delighted to have a wonderful, diverse panel of speakers, and we're going to discuss ESG and impact investing, how the landscape is changing, what are the challenges and opportunities. So you've seen the bios of everyone, and I would actually like to start with Hala Fadel, who is an MBA from 2001. Hala, welcome. And you have a lot of experience as a portfolio manager in ESG. And I wanted to ask you, when you are looking at companies across regions, across geographies and across sectors, how do you go about comparing them in terms of ESG? This is a question I actually picked from the list that was submitted beforehand from the registrants.
Thank you, Gita. And first of all, thank you for having me, and very excited for this panel and the whole reunion events in general. So this is a question that is very interesting, looking at different sectors and geographies in terms of ESG. So environmental, social, and governance criteria, when it comes to funds, attract really more and more investors. And this is, I think, recent numbers by Morningstar show a growth of 30% in Q1 of 2021 for ESG investments in general. So we can clearly say it is one of the fastest growing financial products, and therefore attracts lots of players in the financial industry. So if we were to look in 2016, so about 5 years ago, the US was lagging about 50% behind Europe in terms of global sustainable investment assets. This came to just 30% behind in 2018. And I would say in 2020, we were around 20% behind in terms of the size of the assets allocated to ESG. But if we take this as a share of the total assets invested, then there's a much larger share of European assets that are invested in ESG funds in general than in the US. Japan actually ranks really good in terms of also ESG investments. So it's a growth area, and in a way, it's really good news for everyone if we believe that ESG criteria work in terms of their impact, which is a topic I will just touch upon right after this. ESG is definitely the hottest buzzword in the financial industry today. And I cannot think of any other product that grows at this space. So it's definitely a very big financial opportunity for asset managers, and they're definitely making the most of it in terms of marketing as well. So if we take the example of BlackRock, for example, they had a stated goal of reaching 100% of their funds being ESG integrated, and they just did in 2020. which is, given the fact that it's the largest asset manager, then it's a big achievement. It is definitely Wall Street's answer to society's growing demand for action on climate, but also action on inequality, because we often forget the word social in ESG. And I would like then to ask the question, will it change anything to the climate problem or to capitalism to be more ESG integrated as the financial industry? So if we look at what it did on governance, it did have a huge impact on the governance of companies. ESG criteria raised awareness around independent board members, disclosures of compensation for management, and also conflict of interest. So you could say we could be hopeful that this impact that it had on governance will also be replicated on social and environmental criteria. When I was a portfolio manager at Comgest, so managing global and European equities, you could add to the ESG scoring of companies some qualitative rating when meeting with management and talking to them about ESG in general. And some were definitely more responsive than others. Some would be surprised, others would immediately jump on the question because they have a passion for it. And I mean, you could question the link between this scoring, this ESG scoring, which is very quantified numbers around emissions and social criteria and governance criteria. And this scoring should be put in perspective with the purpose of the company, because you could have companies like, I don't know, Expedia or BP having AAA scoring in ESG, but at the end of the day, if you think about it, one is promoting air travel and the other one is an oil company. And this is where the role of the portfolio manager comes into play, to maybe push the criteria into not just ESG criteria, but also the purpose of the company, and look more into the culture of the company and what it is exactly trying to achieve. So if I go back to the question, will it change anything to climate problem or to capitalism, is the Wall Street answer to society's growing demand for action on climate a good one? To answer this, I will quote a person called Tariq Fancy. He's the former ESG head for BlackRock, and he recently left. And he took this analogy that I will take also here. And he said, if we were in the 1960s and Martin Luther King decided to fight his fight, asking people to use 401ks to divest of companies that discriminated against Black people, will it work? Probably not is the answer, given the urgency and the importance of the issue. So I guess ESG criteria is a good way to have a scorecard of where a company or a sector stands, but then going forward, we'll definitely need regulation.
Thank you, Hala. You've touched on a number of points which people who are very skeptical of ESG bring up. And one of them is that even if one doesn't believe in ESG being a value driver for companies, there's the sheer momentum that pushes us. And then there's regulation. Europe is much further along in terms of regulation and disclosure, but it does appear, transparency, disclosure, and accountability, right? Those three things, we will need those if we are to push our agenda forward. So I'd like to turn now to Justin and to ask you, Justin, your experience has been in the US and in a very interesting area in educational technology, in EdTech. And this is a very hot area in impact investing, ESG investing. And I want to ask you, when you look at it, I don't think, it's not coincidental that both you and Hala graduated from Sloan. at a time when the world economy was in distress. She was 2001 and you were 2009. And these kinds of times can basically peel back, right? It peels back and it exposes many of the issues we face. I wanted to ask you, what are the challenges you faced in terms of scaling up the kind of impact you want and balancing it with financial returns for your investors?
Yeah, so there's a lot there. Thanks, Gita, for the invitation. So I'm a partner at a lower mid-market private equity firm. So I look at the world through that lens. And you're right, I did graduate in the Great Recession. I've had the experience of graduating to two of them. And so it is sort of deeply rooted. But I would say more informed than that experience was actually the reason why I joined, decided to go to MIT, which was at the time, the president, Susan Hockfield, had a quote that she wanted MIT to be the place where little kids dream of making the world a better place. And I believe that was true, and that technology would be one of the positive drivers of that change. And we're seeing that play out in real time. So technology is not the only lever; it also can be a force for negative things, but it can be a force for positive things and to create scale effects, certainly to tackle environmental challenges and education challenges, etc. From the lower mid-market perspective, we invest in companies that are seeking to one day become public entities, that are building up their operational capabilities, that are building up their teams and their product out into the world. And the habits that they practice, which is how we think about ESG, and what they give to the world, if it's world positive, which is how we define impact, is we think one of the best ways to create long-term value. And so we've taken great care at TZP, which is one of the first lower mid-market private equity firms in the US to have launched a dedicated impact fund, to get our vocabulary correct. Because when you define some of these terms interchangeably, which happens in the market, it's hard to disentangle what's actually causing value, if you've caused value at all, and whether this is a practice worth doing. And so we think about it in a few sort of simple ways. The first is that we're participating in a continuum. So we think about the ABC framework: avoid, benefit, and contribute. Avoid is staying away from things that we know are world negative: munitions, fur trading, pornography, human child labor, things like that. And those tend to be relatively uncontroversial, although around the edges, things like gambling and alcohol and cannabis, I think there's still some debate out there. But many public and private investors think about the world through a responsible investment lens. The world has evolved to the B, which is benefit, which is ESG habits largely. And this is how a company should act. And we think about this not from the E, S, and the G, which are frankly an odd federation of habits. They don't naturally belong together, but as a way to, but through a stakeholder lens. And so we've defined 7 stakeholders: investors, management, employees, customers, suppliers, partners, the community, and the environment. And we think about it in 2 dimensions. What are the risks associated with those stakeholders? And what are the value unlocking opportunities for those stakeholders? And so every company will have 14 different boxes, and they may be strong on, for instance, volunteerism in the community, but weak in terms of the environment. And so to Hala's point, most companies are not perfect in every dimension. And when we say a company is strong on ESG, I think it confuses the point. Companies will make decisions based on their own business imperatives. And what we're looking to do is to analyze what are the risks, the material risks worth mitigating, and then what are the things that we can bring as investors to help unlock value. And it could be encouraging a consumer company to declare that they're moving toward carbon neutrality by 2025, or employing better fabrics because their consumers are demanding it, or employing a diverse workforce because it's in their interest to have creative ideas around the table. And we think about those in a structured way. And then we move to impact. And impact is not about the habits of a company, it's what the company gives to the world. Not every company is going to be world positive, and that's okay. But I would take a positive approach on the value of ESG and impact in the private markets, which is to say, there certainly is a place for government intervention and regulation and pulling us all together, and that is actually the best form of why government exists, to make markets work better when they don't naturally work and collaborate. And there's a place for nonprofits, but the private market does have a place in this, and we see that from two dimensions. We see that as a push from consumers. They are demanding of their companies that they act better in many ways, and we see that from capital as a pull. And so from a GP perspective, I think that this is net positive. We've taken the step of saying, not only are we not going to lean against this or be neutral about it, but we think that this is the best way to cause value. So we don't think about this as a way to trade off returns. We see market opportunities where other people don't.
Thank you, Justin. That was a very compelling thesis. I think we'll see what the audience thinks. I want to turn now to Lydia. Lydia, you work in clean energy, and a couple of questions for you. One is, you're researching and trying to invest in breakthrough technologies, right? Like hydrogen fuel cells and so on. Maybe you could share with us, with the audience and us, the kinds of financing structures that Generate Capital has found work. And also what your thoughts might be on what is called transition financing. There's a lot of talk about that. And, and I think, Ryan, if you want to jump in, because there is a role for corporate venture capital in that space, that is transition financing to help companies that are engaged in fossil fuel related activities transition to a carbon neutral economy, right? So I'd love to hear your thoughts, Lydia.
Yeah, thanks, Gita. Hi, everyone. My name's Lydia. I'm currently an investor at Generate Capital. Generate is a company that finances, builds, and operates sustainable infrastructure projects. We were founded about 7 years ago to specifically fill in a capital funding gap that's between venture capital, who typically finance early stage technology development, and traditional project financiers who are banks like Wells Fargo, US Bank. They typically only target really low risk investments in renewable energy, things like utility scale solar and wind. And as you know, like venture capital investors require pretty high return on investment, which makes it not efficient for companies to use VC funding for project deployment once the technology is already commercial ready. But these technologies might not be so proven that you can demonstrate that it's de-risked to get access to bank funding. And that's where Generate fits in. We partner with product developers, utilities, and technology vendors to deliver sustainable infrastructure that are decentralized and decarbonized. And currently, we're pretty active across a wide range of sectors in power, mobility, waste, and water. We now operate about 2,000 distributed sustainable infrastructure assets, and that's serving over 1,000 customers. Whether it's corporate, cities, school districts, and nonprofits, we serve them all. So as an investor at Generate, I'm currently primarily focused on opportunities in the clean transportation vertical, which, as you mentioned, that includes EV, fleet EV charging, hydrogen, and fuel cells. Some of these sectors are, I would call them, new to the financing world, but the technology itself has existed for a long time. So this is not the breakthrough technology that we typically think of that literally just got invented, with a history of the technology actually working and the need for capital to deploy them at large scale, that's where Generate Capital really plays a role. We typically provide non-dilutive financing for these companies to utilize low cost of capital funding and make sure that that technology itself is commercialized at large scale and creating really the environmental impact that we want to see in the world. So yeah, that's the high level of what we do. And I can also just jump into the next question of how transition financing work for fossil fuel companies, and then I'll let Ryan take over. So we have seen quite a few oil and gas companies that set up corporate venture capital over the past decade. People like Shell and OGC, Oil and Gas Climate Investment, which is a $1 billion fund put together by over 10 major oil and gas companies. They focus on climate investments to kickstart that transition and allow these oil and gas companies to have a side vehicle indirectly contributing to climate change. And there's a stat that shows that in 2019, before COVID, oil and gas corporate ventures are at a record high of investment into clean tech startups, which was really great news. And many of these companies also, especially the European oil and gas majors, in addition to VC, they have also deployed capital directly into renewable energy projects. It's the same type of projects that Generate and other project financiers fund in solar, wind, and especially offshore wind. But recently, as in all the news articles that we've seen, the efforts that they've made so far seems to be insufficient. And a lot of shareholders have decided that we want to push them to go further. So what is next? So what are the areas that they can invest in? I would say some verticals have certain adjacencies that oil and gas companies can already utilize their either talent or market access to help finance, especially those areas that traditional renewable energy developers might be a little bit hard to get into. And these verticals include offshore wind. As I mentioned, offshore wind is very complex in terms of construction, installation, and operations. It's very similar to offshore oil and gas. Geothermal is another one because of the drilling and a lot of technologies that you utilize that's similar to oil and gas industry. In hydrogen, which is the sector that I cover, right now the hydrogen sector is controlled by a lot of major oil and gas companies just in terms of up and down the supply chain. And then finally, carbon capture, utilization, and sequestration. CCS is a new sector that a lot of oil and gas companies want to deploy capital into because obviously that is essential for them to reduce the carbon footprint as they continue to do their business. So just those are some examples of how transition financing might work. And I'm happy to kick up to Ryan to add to that.
Lydia, thank you so much. I loved your last comment about carbon sequestration, because to the extent that we can get an efficient carbon marketplace going, that's a critical element, right, in all of this, for carbon credit trading and so on. But Ryan, would love to hear your thoughts on this.
Thanks, Gita. And I get the luxury of going last relative to the all-stars of Hala, Justin, and Lydia. So there's plenty of different threads to be able to pull on here together. Maybe just a quick introduction on what my role is here within Autodesk and leading our impact investing function, and then picking up on some of the things that have been talked about before, because I do think they're really interesting relative to this broader conversation of ESG and impact investing. So my name is Ryan. I originally from Virginia, migrated up to Boston as a part of the 2-year MBA program back in 2015. Still stuck around the area. So if you're local here in Boston, please come say hello. I lead impact investing for Autodesk. If you're not familiar with the company, it's a large publicly traded software company that helps designers and innovators be able to do 3-dimensional design, architecture, construction work. Thinking about why we are allocating capital with intentions around impact, there's these sort of 3 different levers of financial return from our investments, the strategic value of our investments, and this intentionality around impact outcomes. using some of the similar frameworks that Justin had talked about, the ABC sort of frameworks. We're operating under this hypothesis that intentionality around all three of those can actually lead to greater value creation and capture for our own business. And a lot of that's actually being driven from the same things that Hala talked about relative to institutional investors thinking about this in their own portfolios. So Autodesk is a company, publicly traded. A lot of our largest shareholders, especially out of Europe, are thinking about ESG as a part of their portfolio criteria. And how that manifests in our business is thinking about how our corporate strategy has materiality to what our impact intent is on the world. And one of the ways in which we walk the walk on our impact is how we allocate capital. And so you can kind of see how all these pieces start to fit back together with one another. Just speaking about the sort of transition and about the carbon markets that you were alluding to there, Gita, we're investing at the early stages in companies that at scale can have demonstrable impact on helping our industries move towards more sustainable, equitable, and resilient economy. Thinking about where we sit, a lot of our customers are in those heavy industries or the built world, which are going to be some of the more difficult parts of the economy to decarbonize. We do believe that there needs to be the project financiers and that innovative types of financing to be able to get some of the proven technologies deployed at scale. We also believe that there needs to be new innovations here across some of those sectors that Lydia talked about. So we're taking some of our balance sheet capital and our philanthropic capital and investing it in early stage companies that do need to do some of that early sort of technology build out with our support, do some of the early product market fit and prove out of commercial viability, and then using where we sit within the marketplace to try to be a market pull. So we invested in a company that is doing carbon dioxide removal using direct air capture and carbon mineralization, for example. Autodesk can be part of the cap table, help the company build out its technology, but can also help to syndicate demand. We have a public commitments to net zero, and we'll be doing some forward pricing contracts to be able to put our own price on carbon and be an off-taker. Same thing happens with a lot of our customers. So I just think it's really interesting the different perspectives that are shared on this call, because you've got just different investors in different parts of that ecosystem, and there's some really interesting connections across all of our work.
Great, thank you, Ryan. And for the audience, I do want to mention that Ryan and Lydia are the youngsters on this call, and I think they're a perfect reflection of the power of the MIT ecosystem. Ryan came to Sloan as an engineer who'd worked in defense, and he wanted to learn about finance. And Lydia came as somebody from finance who wanted to learn about engineering to do what she wanted to do. And I have to give her credit. She managed to take some pretty hard engineering classes. So, this is the power, I think, of Sloan and of MIT. So I'm going to actually ask you all a general question, and then I thought we can open it up. Thank you so much for all your insightful, your comments. But Hala, sorry to pick on you, but I'm going to start with you again. But I'm going to open it up with a general question. There is a lot of concern about greenwashing, or now as it's called, impact washing. And in Europe, they're rolling out regulations related to this, particularly the FSA in the UK. The SEC is looking into it as well. And this is, on the marketing side. So Hala, you are a very experienced, seasoned investor. And I wanted to ask you, from an investor's perspective, how do you approach this issue?
Wow. So yes, there's first on the regulation part, there are a number of new regulations in Europe coming up, and notably in Europe, the Sustainable Finance Disclosure Regulation, SFDR, which is very, very heavy and requires every company making green claims to substantiate those claims and documenting everything. So both on the company level, but also on the investor level. And a number of investors are panicking about this. There was a recent survey, only 17% of investors are comfortable they'll be ready on time with this regulation. So I guess it gives incumbents a competitive advantage. And I don't necessarily like that, although I would consider Comgest as an incumbent, because it's all like a bit what I said earlier, like a scorecard and numbers and reporting, and it's a ticking the box exercise, and who keeps the big picture. And Justin was saying, you know, all the criteria they look at and the qualitative criteria that are important when you're an investor, really looking for a true purpose with those companies, and ESG not as a ticking the box exercise, but really having the some kind of proof that you're investing in a company that's sustainable long term. And just one thing that's really a bit attached to that, it's the long-term versus short-term investor here, and long-term versus short-term companies. And a company that really is looking to be a long-term winner typically takes these into consideration very early on. And so the fund manager should be looking at how a company anticipates those ESG issues for the future, as opposed to ticking the box today. And I'm convinced that this leads to better performance also in the long term. So I don't know if I clearly answered your question, but, you know, greenwashing, it's good to put regulation in, but it doesn't substitute for a portfolio manager that sees, you know, the true purpose of the company in the long term, as opposed to them having ticked all the right boxes.
Yeah, I guess if I may paraphrase you, you're saying the portfolio manager has to find companies that can build sustainable businesses for the long term, that are stakeholder focused. And if you're trying to identify those kinds of businesses, you will see through the greenwash.
Absolutely.
Anyone else have any thoughts? Justin, would be curious.
Yeah,
to operate in a space.
I can lend my perspective. So, you know, frankly, for practitioners, adhering to ESG is pretty difficult to do. It's difficult in a variety of ways. If we were to ask this experienced panel, what are the components of ESG, you'd get different answers, even with the best intentions, because there is little regulation from the industry accepted frameworks. First off, there are no commonly industry accepted frameworks. There's a collection. The way you apply those frameworks is ad hoc. As just as an example, SASB has 77 different flavors, and companies don't neatly fit into, many companies don't neatly fit into any of those 77 flavors. And so the application of regulation to the ESG market, frankly, is a good thing if it's implemented correctly, because it provides rules of the road. In fact, you make an argument that, you know, the way the world market is organized today is only successful because of regulation. And without rules of the road, without how we define what an income statement looks like, without understanding how banking rules are supposed to be, we wouldn't know how to sort of cooperate and commonly talk, etc. So having common rules is important. Now, the challenge becomes that the way that different groups care about different things. They care about things in different ways, and that there are different measurement tools. And so the regulators have to work with standard bodies and with industry to define how you measure. Just as an example, we've been doing a carbon footprinting exercise for our own portfolio companies, and we used 3 tools, and we had 3 different orders of magnitude. That defies belief. And so the question is, which do you choose? And if you choose one, how do you know that will be true later? And so we do need a common set of vocabulary and habits. And so I suggest, not that anyone's asking my opinion, to regulators to start with things that are sort of commonly accepted and that are easily countable, and then to incrementalize. The other thing I'd say is that ESG is not a defined thing. It is ever changing. So the sensibilities that we have around environment are relatively new, The sensibilities we have around diversity are extremely new. And the sensibilities we have about corporate governance are a little less new. That we see every single day, computer hacking being just a national and a world topic. This is in the moment, and it's part of ESG. And so this is an ever-changing landscape. And one of the challenges that what regulators will have is making sure that they are meeting the market, allowing the market to know the rules of engagement, but the market will continue to constantly evolve. And so we need to appreciate that ESG is a living body. The best way to think about ESG is not really about the environment, about social, and about governance. The real way to think about ESG, again, which is an odd federation of sort of habits, is that it's a commitment by companies to act in the right way. And it is dispelling sort of the Milton Friedman belief that the only group that matters is a shareholder. It's that if you actually are a long-term investor, you should care about the other stakeholders, because it's in your financial interest to do that. And so time is operative. But because time is operative, regulators need to appreciate that some of these things take a long time to address, and they're not a snap of the fingers. Just take, for example, diversity at the board level. We have 27 companies in our portfolio. We've committed to doing better. If we wanted to do better by adding one diverse member on each of our boards, that's 27 hires, in addition to all the other hire work that we have, and we have one talent partner. And so to make that improvement in 1 year, and that's just one person, is hard to do. So you have to also accommodate for time as an important component. So I think the regulators do have their work cut out for them. I think it would benefit all of us who are investing in the industry.
Thank you, Justin. That's so true about board diversity. It's a time-consuming process, and you have to be thoughtful. It's not just about getting a woman on the board. It's about getting a person with the right experience who can actually bring value to that board and help increase stakeholder value in general, right? Lydia, Ryan, do you have any questions? Any thoughts? And otherwise, I'll open it up to the audience for questions.
I just quickly will underline, I think that the point around the time variable is a crucial one here, and important across all those different levers of practitioners, investing capital, regulators, and different sort of ecosystem tools and framework bodies for how this starts to align. If you think about this being beyond just ESG and more towards value creation for all stakeholders, how you define that will evolve over time, which is the natural evolution of any society. So I think that the time flexibility matters here.
Mm-hmm. Lydia, any thoughts, or should we?
No, I think it's all covered already, not to repeat anything.
We are starting at the risk of sounding like a meditation session. Intentionality and purpose seems to be coming through loud and clear in what everyone's saying. So I'd like to open it up now for questions, and we have already received a few questions through the chat, and I'm just going to go through that now. But if anybody has any new questions that they would like to put in. There is a question actually for B corporations, which is actually an interesting one. Someone in the audience says they're a late stage startup focused on closing the digital divide in sub-Saharan Africa, and they wanted to incorporate as a Series B. And this is from Solomon, Israel. But they were confused by the process and the value. B Corp is a big thing nowadays. So I was wondering if, I don't know who wants to take that. Anyone?
I'm happy to jump in. We're spending a lot of time with the questions of B Corporation. So everyone knows B Corporation is a private designation that companies can adopt. It shouldn't be confused by the public designation, which is to be a public benefit corporation, which is a legal designation. B Corporation, is a reasonably high standard for how businesses should act. It aligns, it maps closely but not perfectly to ESG habits, and sort of has a feeling of impact sort of baked in, but it does have differences. And more than anything else, the value of a B Corporation is really a virtue signal, a signal to the stakeholders that you're addressing that you care about doing better. And it tends to be about companies who, in principle, care about communicating that to their customers or to their employees. I would say that investors are starting to notice that designation, but it's certainly not operative for most investors today. I would say that if you're going to take the significant effort of becoming a B Corporation, you're not doing it because you want a badge on your website. In fact, I would say that's sort of the tail wagging the dog, and that's sort of true for all of these ESG habits. If you're doing it for the signal, it's too much effort and it won't be durable. It'll fall away. They'll change their standards. You'll have to catch up. You should do it because you think it's in your best interest to act that way. It's the way that your employees communicate with each other. It's how you communicate with your customers. But it's a lot of effort. And so it's one of those things that it's actually good that they raise the standard reasonably high. For companies who adopt it, that they've taken a great deal of care and time to employ it, but it shouldn't be confused with impact. Just as an example, Ben & Jerry's is a B Corporation. They sell sugary milk, cold milk to people. And while I like Ben & Jerry's, the world doesn't necessarily need more of that. Or maybe you can make the argument that it does. But it is not an impact company. Now they have good habits, and so it really sort of the way they practice B Corporation is it really relates to sort of the ESG habits. So I would say do the habits, Justin, and then get the designation.
Yeah, Justin, can I just move on to another question? Thank you.
Absolutely.
There is actually a question about digital currency and blockchain. Are they? I don't know if they're referring not to digital currency, which is central bank digital currency. They might be talking about crypto. And is it misaligned with ESG principles? And they're refer to messages by Elon Musk and Tim Draper. I wanted to ask you, Lydia, and then you, Hala, as well. What do you think about that? There's been a lot of press about the fact that crypto is, is very, very energy intensive. There was an article in The Guardian, right, that it takes as much energy as a small country generates.
Yeah, so crypto mining, same as data centers in general, it is very energy intensive, and it requires very reliable baseload power, which is something that we really need to solve. I am no expert in cryptocurrency, but I'm happy to talk about how to make data centers overall greener, which is something that we definitely work on, generally partners with large technology companies to figure out solutions of how to provide green 24/7 reliable green power to these data centers. And one of the solution is we can consider using hydrogen or fuel cells to really replace baseload power that used to be either natural gas, coal, or other sources, because hydrogen fuel cells is really zero emission. And based on how the hydrogen is generated, you really see the whole value chain being able to be zero emission up and down that supply chain. So yeah, I see there are a lot of different opportunities that we could potentially invest in infrastructure to support the expansion of the need for data centers, online infrastructure, whether that's for cryptocurrency mining or whether that's actually just for regular servers that we utilize every day. I think we see a lot of opportunities there.
This is great.
If I can,
please, Hala.
sorry, I interrupted you.
No, go ahead. Yes.
Yeah, no, I wanted to add maybe a different perspective, not just looking at the energy impact of crypto, but more on the utility and maybe the tokenization of the economy and potentially turning the economy into a real sharing economy with all the stakeholders having a cut, so to speak, into the economy, and not, as Justin said, or Milton Friedman said, the shareholder being the only stakeholder that's important in the equation. So we're a long way from this, but if the concept of crypto works in the long term, then we would be better off in the S of the ESG, the social redistribution of the utility function of a company, leading to more distributed wealth. I don't know if it answers the question, but it's not just on the E, but also on the social aspect of the crypto economy.
It is definitely, there is an inclusion aspect to it. That's right. I saw at the gas station, actually near the Sloan building, there's a Bitcoin ATM, to your point. So while you're pumping your gas, you can buy some Bitcoin. You know, there is definitely an inclusion aspect. That's a really good point. I have a question actually for Ryan. This has come from David Grossoff, which is, do you think that companies that brand with a mission, I like the way it's worded, companies that brand with a mission, do they attract employees who are more committed to work well and hard with the company? Are they more contentious and willing to stage walkouts and fight with each other, or three, both? And this, David is thinking of Google versus Facebook.
I really like the question. I think it's an interesting one, and kind of gets back to what Justin was mentioning relative to the B Corporation designations, and to what degree mission and vision is truly authentically baked into how you make decisions on a day-to-day basis as a business. I think there's really good studies out there that show that those companies that are communicating their long-term mission and vision to key stakeholders, including employees, do better on some of those performance metrics related to churn and tenure and overall well-being of employees. But I think the same can hold true, that if there is a perception that you're deviating from that long-term mission and vision, and that perception can be authentic, or it can be through how you're communicating it, that you absolutely are going to have sort of a key stakeholder there, your employees, who are going to be holding you accountable. So if I were to take a sort of the multiple choice test there, I would say C, which I would argue is a good thing if you're going to continue to think about stakeholders as a part of your long-term business and value creation.
Mm-hmm. And conflict is not always bad. In fact, it is actually a necessary part of functioning, right? The question is, how do you resolve it and how do you move along? I think we're nearing the end of our session, and I would like to, if there are no more questions, I would actually really like to do a quick lightning round. Justin, you've been on a panel with me before. So the first round of questions is going to be, I wanted to ask each of you personally, if you have to think of one thing that you want to do or are doing that would have impact in the next, say 6 months to 1 year, can you share that with us and with the audience? So again, Hala, I'm going to go with you.
So I stopped eating red meat.
All right. Okay.
That's an easy one. I have a whole list of things that we decided as a family to do to have an impact on the environment.
All right. Ryan, you're next in my Zoom boxes, so I'm asking you.
We're, me personally, taking a really critical look at not only what we're investing in, but how we're investing in it, and some of the implicit bias as how we allocate resources.
Mm-hmm. Okay. And what about you, Lydia?
Yeah, we've been looking at some sustainable material companies when we're seeking for investment at Generate. So that inspired me to personally replace a lot of the plastic materials that I see in what I use on a daily basis. And I also realized that there are a lot of biodegradable plastic products these days. You can easily get those on Amazon. They will dissolve in water after 90 days. So replacing plastics in your household with those will be very helpful.
Well, given that you live in San Francisco and you probably live in a shoebox, I hope that's not biodegradable, right?
No, my paper straws though are dissolvable, so I really do not like to use those. Luckily, we now have better products to replace them with.
And Justin, what about you?
Yeah, like Hala, we're trying to remove, or minimize animal protein from our diets as much as possible. It feels like one of the more controllable things. If I had my choice though, I would figure out a way to not have so many cardboard boxes from Amazon in my house. It drives me totally bananas, but there's no way that I, as a consumer, have figured out how to navigate that, at least in a pandemic.
Mhm. Yeah, well, it is a huge burden on municipalities. Our town, Brookline, is refusing to take Amazon boxes anymore. They say you have to take them to the Amazon drop-off point, and they're supposed to recycle them. So for myself, I just wanted to share with you, I started composting during COVID, and we have a company called Black Earth Compost, which operates on a very funny business model. As more customers sign up, the price comes down. So they're clearly not trying to maximize profits here. But it's a great company. It's industrial composting, and our solid waste trash has gone down 90%. So that's that. Well, we are close to the end, and so I have one last lightning round. Justin, I'm going to start with you. Your favorite song?
Well, I've said this before on your panel, but every evening we end the day with my son goes to bed with Dance Party, and we play "Wake Me Up Before You Go" by Wham.
Oh, I love that. Okay, Lydia, your favorite song?
I would say Above and Beyond has a song called "We Are All We Need," and that just really rings to me.
What about you, Ryan?
Anything by Otis Redding. Sitting on the Dock of the Bay is my go-to karaoke song.
Okay, all right. And Hala? Hala, you're muted.
Sorry, I said anything by Rihanna. Maybe We Found Love.
Okay, great. Thank you all so much. I feel like we've all learned so much from this. And thank you for taking the time to participate. Lydia, you woke up very early. Hala, it's later in the day for you. Thank you so much for doing this. And thank you for being such loyal alumni and giving back to the school.